Good afternoon, everyone, and welcome to Brian Financial Empowerment LLC's Sunday afternoon financial broadcast. We talk all things money, all the things that impact your money. We talk about it here on this YouTube channel. I am Dr. Severin Bryan, a financial educator and a financial coach. Today, we're going to be talking about cosigning. And a lot of people, I'm one of them, who did not quite understand what it meant when I cosigned for someone else. In college, just as after I left college and got my first job, a friend asked me to cosign, and I did. And when they defaulted on the loan, GMAC called me. GMAC kept after me to pay the loan. So it is important that we understand what cosigning is. And so today we're going to be talking four main talking points. It's what is cosigning? What are the impacts of cosigning? Can you remove yourself as a cosigner? And when should you consider cosigning? So first of all, what is cosigning? When you cosign a loan, whether it's an auto loan, student loan, personal loan, a mortgage loan, basically what you're telling the lender is, if this person does not pay, I am going to pay. So if that person defaults on the loan, it doesn't matter if you're not driving the car, it doesn't matter if you don't live in the house, it doesn't matter if you did not get the benefit of the loan. Basically, you told the loan servicer that if the person defaults, you take full responsibility. So that's what cosigning is. Cosigning is me saying I am responsible if the primary person does not pay. So you might want to think twice. Now, what are some of the impacts of cosigning? As I said before at the beginning, I cosigned for a friend who defaulted on the car loan, and GMAC kept calling me. By the time GMAC called me, there were already several mispayments. And so my credit got impacted. And I ended up eventually starting to pay on the loan, but because I was not privy to when the loan was defaulted on, by then it was too late. So one of the things you might want to consider if you are going to co-sign on a loan, one of the things you might want to consider is getting access to that account so that you are aware if that person is late, because you have a certain time period when they're late before it reports to the credit agency. So if you are on the account, or if you are privy to the details of the account, then you can counteract that. You can go in and jump in and start paying to protect your good credit. Another thing that's impacted when you co-sign a loan, and they don't even have to default, is your debt to income ratio. So let's say you make $5,000 and your debt that you have today is $1,500. Okay, so your debt to income ratio is what, 30%? And you co-sign on a loan and you're going along and you're fine, and then the loan you co-signed for is $1,000 payment. So now this person has defaulted, and even before they've defaulted, once you co-sign on that loan, now your debt to income ratio is 50%, because your personal debt is $1,500 on a $5,000 income. So that means you're at 30% debt to income ratio. If you co-sign on a loan for somebody for $1,000, and you might say, oh, they're paying their loan, they're fine, I don't have to worry about it. But now, because you've co-signed on a loan for $1,000, your debt to income ratio is now 50%. So that's something that a lot of people don't consider is, oh, well, I'm co-signing a loan, they're paying, I'm good. But it affects your debt to income ratio. And here is how that could impact you in the future. If you decide you want to buy a car or you want to buy a house, that loan is considered part of your loan. So now your loan is your debt is 1,500. Your debt to income ratio is 30%. You co-sign for $1,000 loan. Now you're at 50%, and you're telling the mortgage servicer that I want to take a mortgage. I want to take out a mortgage. They're going to look at your debt load, and they're going to see that you're going to exceed your debt to income ratio is going to exceed 50%. And you're more than likely not going to get that loan. So that's something that you really need to consider, and that's something that a lot of us don't consider for the future. It's not about helping that person. It's not about the fact that they can afford it. How does it impact your credit? How does it impact your debt to income ratio? And here's another thing that you might not consider. When you co-sign on a loan, you are on that loan for the duration of the loan. Now, there's some exceptions, which I'll go into in a little bit. But if you co-sign on a loan, a 10-year loan, you are on that loan for 10 years. It doesn't matter if that person paid on time. You are on that loan for 10 years. Okay? Now, if the person defaults and the loan servicer were to sue, you are liable for the full amount of the loan. You may say, "What? It's not my loan. I'm just helping." Doesn't matter. You are liable for the full amount of the loan if you are sued. You know, boyfriend and girlfriends sign loans, co-sign. Hey, I'm just trying to help him out. I'm just trying to help her out. I'm just trying to help my mother-in-law out. I'm trying to help my sister out. I'm trying to help my brother out. And then when they default, it could be intentional because you break up and they don't care if your credit gets messed up because they had bad credit anyway. That's why they needed you to co-sign, right? They already had bad credit. So now they don't care. They're driving a car and they don't care. And they'll hide the car because they don't care if your credit gets messed up because it's already messed up. But then you with the good credit who they asked to co-sign on that loan, you are up the creek. You don't have access to the asset, but you are now having to pay. And if they sue you, they're coming after the full amount. So boyfriend and girlfriend break up, as I said before, and they one stop paying on the note, and the one who co-signed is stuck with that. And if you cherish your credit, you cherish your credit score, you're more than likely going to want to pay. So you want to consider that. Again, the things you want to consider: how it impacts your credit score, how it impacts your debt to income ratio, the fact that you're on the loan for the duration of the loan, and it doesn't matter if they're paying or not. You're on the loan for the duration of that loan. And the fact that you could be liable to be sued for the full amount of the loan. And let's say the loan servicer decides to forgive the loan. Here's another wrinkle. If the loan servicer decides to forgive the loan, you may end up owing taxes on the difference. So if you had a loan of say $5,000, you had a loan, it's really not, you understand what I'm saying. You co-signed, so you had a loan of $5,000, and the loan servicer said, okay, I'll take $2,000 and I'll just write off this loan. The fact is, you could end up owing tax on that $3,000. Okay, you could end up owing tax on the $3,000 that you settled with the loan servicer. So you have to consider those things. Yes, you want to help your family. Yes, you want to help your friend. Yes, you want to help your boyfriend. Yes, you want to help your cousin. But you better consider all of these things. Okay. Now, here's the question. Can you remove yourself from a loan? And the short answer is no. You can't say, you know what? I broke up with him. I don't want to be on this loan anymore. I divorced her. I don't want to be on this loan anymore. It doesn't work like that. They will have to be able to refinance the loan on their own. Now, there are some loans, typically student loans, where you may be able to get a co-signer release clause put in. And if you're able to do that, then under certain circumstances, you may be able to be released from the loan. Very rare, but you can probably try to negotiate that with the loan servicer and say, under these circumstances, can I be released from the loan? And if you have that language in there, then you may be released from the loan. But for the most part, the way you're released from the loan is not because you're tired of this person, not because you're divorced, not because you break up, not because you fall out with your family member, but because that person can now refinance on their loan. Okay? Now, the fourth point that I wanted to make is when would you consider a good time to co-sign on a loan? Well, if you have a child who, is very responsible and they, very manageable, very respectful, they've just graduated from college, they have a really great job, and you know that they're going to need a new car, or they're going to need, or a new to them car, or an apartment, then you might want to consider co-signing, because after several months, they can now go to their loan servicer and they can say, hey, my mom helped me out, my dad helped me out, my cousin helped me out, and they co-signed for me. Now I'm in a position to finance on my own. I have the credit score that's been built up, and now I because of my record on my job, I can co-sign, I can refinance on my own. And then in that case, then you might want to consider that person. That person is a good bet, so to speak. But in very rare circumstances, you want to consider that. So again, I just want to go over the points. What is co-signing? You are agreeing to the debt of the person you are co-signing with. It doesn't matter that you're helping. You are agreeing to take on that debt in full if that person defaults. Give it some serious thought. What are the impacts? Your credit score, your debt to income ratio. If you intend to make major purchases in a few years, a few months, your debt to income ratio could be significantly impacted, causing you to not get that loan. You're on the loan for the duration of the loan. You could end up owing taxes if the loan is forgiven, and it stays on your credit report as a charge-off. So you want to consider that. Can you remove yourself? If you get upset with whoever you co-sign for, can you remove yourself? No. They have to be able to refinance on their own, or if you had a release clause in there as a co-signer, then if it applies, if the situation applies, then you can get released from that. And lastly, when would be a good time for you to consider co-signing is maybe if you have a student just graduating, building up their credit, you co-sign, and then they're in a position a few months later to finance on their own, and then they'll be able to do that. So I hope this has been helpful for those of you who may be considering co-signing, because I know a lot of us, we try to be helpful, and we just want to be a blessing to somebody, but we end up hurting ourselves because we don't understand the full ramifications of what we're trying to help with. So I hope this has been helpful to you. If you want to connect with me, of course, subscribe to my YouTube channel, and you can be aware of upcoming broadcasts. Subscribe, hit that notification bell, and you can be made aware of future broadcasts. And there are times when I'm going to have some guests. I have some guests lined up coming up in the future, and we'll be talking. As I said, we talk all things that impact your money. Anything you can think of that impacts your money, we'll be discussing on this channel. And if you want to contact me on IG and Twitter, you can find me there as Sev Talks Money. That's Sev Talks Money. On my website is sevtalksmoney.com. And of course, my Facebook business page is just as it's on the bottom of the screen there, Brian Financial Empowerment LLC. So thank you again for joining me on this Sunday afternoon. We do this every Sunday afternoon at 4:30 p.m. Eastern Time, and I hope to see you next week.